No investor wants to miss out on a booming market when stocks are on the rise. But where do you begin? A rising tide is supposed to lift all boats, but sometimes the market has other things in mind. In this episode, we're diving into the best moves to make while stocks are on the rise. Your go-to guide to identifying opportunities while managing risk. Before we get started, be sure that you subscribe and turn on your notifications because every time we drop a new episode, money is made. Number one, look for stocks that are being ignored. I'm not talking about weak companies that are simply underperforming. I'm talking about companies with a history of great performance that people seem to not be currently interested in. When the market needs to find some additional gains after driving their current favorites to ridiculous valuations, this is where they'll likely look next. Find the stocks that are trading in a long-term uptrend and have a high return on invested capital. Most importantly, find them when they are beaten down and not participating in the rally. These stocks cannot be ignored forever. Eventually, they always get invited to the party. If you pick these stocks up while they're down, you will be rewarded. Of course, be sure to research and make sure there aren't deeper reasons the company is currently down. We don't want to buy companies that are falling out of favor for a good reason. Sometimes the market also has it wrong. For example, when Meta Platforms decided to dive into a new technology and focus on exploring new ideas, the market panicked. They sold the stock off in mass and somehow forgot just how much money this company makes. If you can identify when the market is making these types of mistakes, this can be your golden ticket. But as I said before, you should also be aware of when the market is right and when a company is being sold off for a good reason. Number two, look for large cap stocks that are just breaking above their 200-day moving average. These stocks tend to be the reason that rallies become extended and go far beyond what others expected. If the market is in the midst of a rally and stats show that the majority of stocks are below their 200-day moving average, finding stocks that are just joining the party can work out very well. Also, look for stocks whose 50-day moving average is just crossing above their 200-day moving average. This is known as a golden cross. This can be a sign that the stock's recent cross above the 200-day moving average is real and has a higher probability of working out. This particular one is more for the technical analysts out there, but it's really not hard for anybody to keep track of. Number three, look for strong companies whose stock take a hit on earnings. This one is big, especially since some of the strongest companies are often some of the largest ones. This means that a big hit on earnings for a large company can not only create an opportunity to invest, but also set back the market's rally. This actually means the rally can be extended. For example, imagine that a company like Apple would drop on earnings. Not only would it drag the market down a bit, but as it recovers, it would also help to propel the market forward. If nothing else, it could give you a discount on the company's future earnings. One recent example is Salesforce. When they released earnings at the end of May, the company disappointed investors and saw its stock drop 20% into the next day. What most people saw was a bleeding company that seemed to be collapsing. What value investors might have seen was a company that was still projected to grow earnings by 16% per year for the next 5 years, now trading 30% below the average analyst target. If there's one thing Warren Buffett proved to the world, it's that there's nothing better than buying a great company at a fair price. Salesforce has recovered by over 10% since dropping on earnings. Investors who bought that day not only already have a double-digit return, but still have a recovery back to all-time highs to look forward to over the next few years. Number four is very important. Be sure that you protect your gains. For some people, that means trimming back on your positions, taking some of your gains off of the table. But for me, that means buying inverse products like the SQQQ. The best time to buy these positions is when the S&P 500 breaks above 70 on the RSI. Start off with a small position and build it over time. These positions are not meant to be held long term, but they also pay dividends to investors that are holding for potential downturns in the market. What's very important is that investors not over leverage in this position. If you were to have about 10% of your portfolio on the SQQQ, you would limit a 10% drop in the NASDAQ to about a 7% loss, not including the dividends you were paid. This position is meant to limit your losses to the downside and pay off during market corrections. Be sure to exit this position and take your gains when you see sharp market sell-offs. You can always enter again. Also, be sure not to dive in on speculation. Only take this position if you truly believe the market will be lower than its current price within 3 to 6 months. The Equity Channel is one of the most followed stock market podcasts for beginners, a valuable resource for investors who are looking for information on the stock market and the economy. We love to make our episodes quick, straight to the point, and rich in value. We hope that's what you got today. Be sure that you subscribe, turn on your notifications, because every time we drop a new episode, money is made.